Welcome to Subramani. Sorry, this during this time of global uncertainty. Global uncertainty is always there. Geopolitical stress is always there. There will always be some Palestine issue, Iran, Iraq, India, Pakistan. Something like this will always be there. But sometimes it is more heightened. There's a war-like situation, maybe even in India. There's a war-like situation in Gaza. So, and then there are tariff wars by President Trump. Now, when all these things are thrown at you, what do you think you have to do for investing? So I belong to the Peter Lynch school, who says that if you spend 10 minutes on macroeconomics, you have wasted 7 minutes, right? So macro is largely out of your control, and you can't really do much, but you can watch what is happening and accordingly tailor your investments. So for example, if you think interest rates are going to be soft, there's a good chance that there will be more demand for goods, because people will say, I don't need to save much because I'm not getting much here, so let me put more money in equity. So they might start putting more money in equity if interest rates are low, saying I hope to get better returns there. But when interest rates in the market are high, people say I'm getting 7% in government securities or things like that. Why should I put money in equity and take risk? So those kind of shifts could happen, and therefore you could see more flows coming into buying a residential. If interest rates go down, people go and buy houses. Is it always true? No, it's not always true, but interest rates is a very important thing in driving residential house buying. Of course, people will buy only when they are more confident about their jobs, etc. But let us look at 2-3 things which you can look at, even for a person like me who says macros are not important. There are 2-3 things which you can look at. First is the Federal Reserve or RBI policy and interest rates. You can look at what is happening. It's a good learning, because there will be 4 in a year and there will be more commentaries on that. So you can read all that and see what's happening and see how the Reserve Bank or Fed is reacting to it. Like if inflation is high, they will definitely want to increase the interest rates. But if growth is suffering, they will want to reduce interest rates. Right? So you can see all this theory which you have read, you can see it being practically used. Whether it is useful or no, you should watch that also. You should see whether interest rates being dropped has a great impact on equity market. Theory says it should. Sometimes it has, sometimes it does not have. So you should also find out why it does not have. Market valuations and growth. Some of the SIPs which I started in March 2020 are giving me such great returns simply because of the starting point. The starting point was just magnificent. Markets were low, expectations were low, so therefore nobody was willing to even invest. People were thinking the risk is too high. So I think for almost 6-7 months I got huge benefits, and even till today some of those funds are showing 27% return, but largely it is because of the starting point. So market valuation and earnings growth are very important. And then of course, like I said, geopolitical and macroeconomic risk. You don't want to invest exactly when risk is high, but look at it this way: when VIX or the calculation of volatility, right, when the volatility index is highest, it's the best indicator to invest, which means there's a lot of panic, people are not investing. It's a great time for you to invest. So 3 ways of looking at everything, right? So first of all, let's look at understanding RBI policy and interest rates. I'm going to use RBI and Fed Reserve or Fed interchangeably. They play a pivotal role in economic stability, influencing everything from corporate borrowing costs, your home loan rates, your car rates, right, all those things. However, instead of RBI or Fed both make statements which you have to be very calm about and not overreact, right? So don't overreact, don't react to sensationalism. They all are prone to doing some sensationalism of talking down the markets or talking up the market. So be very careful. So first of all, learn to focus on data, not what they say. The commentary is also important, but you look at data. If interest rates are low, if inflation is low for continuously 2-3 quarters, very good chance that interest rates will go down. It will not go up, right? The the RBI is very, very clean and very, very closely watching inflation rates. They are targeting inflation is something which we have been doing since 2014. Both Raghuram Rajan and Narendra Modi were very keen to do it, and it has been done very successfully so far. So you can also look at Bureau of Labor Statistics, Bureau Employment data, all that data, economic data which RBI releases. Shamika Ravi makes videos which are very good, which are data-based articles and data-based videos which she makes. So have a look at them. So that will also tell you. Ira Duggal is another person where you can watch and learn about what RBI does. Of course, there are others also. There are some television channels which do a good job, but ideally go to the RBI bulletin and learn to read from that. Recognize the cause and effect. See if interest rates go down, are car sales going up, or are car sales not going up because the market is not, because the companies are not doing well. When the company is not doing well, they are not going to, people are not going to buy a car just because interest rates are down, right? So understanding all these nuances is very useful. And also there will be short-term reaction and a long-term reaction. So see how the long-term interest rates react and how the short-term interest rates react, right? So if long-term is 7 and short-term is 4, you know that short-term will slowly pull down the long-term also in the immediate future. So that 7 may not be sustainable or 4 may not be sustainable. You have to see which is going to be more sustainable. Second thing which we spoke about is market valuations and earnings growth. Again, distinguishing what is happening and speculation. For example, a lot of money has been flowing into the US market. So you keep looking at the number as to what percentage of global market cap is US. So if US is 67% or 70% of world market cap, you know that US is perhaps highly priced, and even in those highly priced US market, maybe only 7 shares are doing well. So understanding the data is very important, even from a macro point of view. So if you think US is overpriced or overhyped, or you think there are 7 companies won't be the ones doing well, there's a good chance that many institutional investors are now going to remove money from US and put it into emerging markets. I'm not talking about this, I'm not putting a date to what I'm talking. I'm just saying that these things can happen. So you have to go back and rely on the fundamental matrices, right, instead of responding to market changes. So look at the PE ratios, look at the PE ratios specific to that market. For example, Korea has a lower market PE compared to India, and India has a much higher market PE compared to US, right? So then don't start using logic like Unilever is quoting at this PE, HUL is quoting at this PE. Look at history also. There is fantastic amount of learning to happen from history rather than logic. Real estate prices in Mumbai don't deserve to be where they are, but historically it has been there. So if you had gone short on Bombay real estate, you would have lost money. Would you have made money if you had bought? I have my views, but if you had short, you would have definitely been taken to the cleaners. Secondly, when you are an investor, adopt a long-term perspective. So if interest rates are, let's say, 7.5% in India, right? So 7.5% is again at the higher end of the spectrum. So at 7.5%, when you buy a gilt fund, you know for sure that you are going to get 7.5% coupon, and when interest rates go down to maybe 5%, you would have made a fantastic amount on the 2.5% change, and that multiplied by your duration, and it's going to be a long duration fund because it's a gilt, right? So those kind of things, understanding the difference between hype and fundamental, saying if interest rates are high, it's a great time to be putting money in a gilt fund. Yes, you will get good returns, and then when the interest rates fall, the portfolio will appreciate, and then you can sell off. So understanding these basic things is useful. Of course, with geopoliticals, I have only one thing to say. There's a Tamil saying which says you cannot wait for the tide to stop before you take a dip in the ocean, right? The tides will not stop. So geopolitical and macroeconomic risk will always have uncertainty, and sometimes it will lack rationality also. It makes no great sense. So for example, the whole world can be protesting against Israel for attacking Palestine, but people forget that it was Palestine who on October 7th, was it, attacked Israel, and then they are paying the price. price for it. People can forget, and we can be irrational, completely irrational. If you take all the left views on Palestine, you're going to be shocked and saying, look who started it, right? So these kind of things will happen. So understanding that geopolitical risks are there is important, and for that the solution is diversification. So if you have a portfolio which has got mid cap, large cap, small cap in India, it's got US, it has got REITs, it's got international REITs, it's got gold and silver. If you've got all this, chances are some things will go up, some things will go down, but on an overall basis your portfolio will be good, right? A multi-asset portfolio. So also then start analyzing the real economic implications of all that you're reading and seeing and watching. Today enough YouTube channels are available, so understand all those things, and then also take a rational approach to market volatility. Markets will always be volatile. It will always experience periods of unpredictability. Investors do not have to follow suit, right? If you are 80 years of age and you have much more than what you require, put a big chunk in a debt instrument so that you can live peacefully for the rest of your life, and the remaining money your children or grandchildren are going to handle it. That can be in equity, so you don't have to worry when there is a fluctuation in equity, right? So try to apply logic to what the RBI says or what the Fed says. Most times it is logical. Sometimes they are taking a shorter term view, you're taking a longer term view. But one thing very clear is investors who maintain discipline, stay informed, read, learn, understand, make notes, come back and read their own notes in the next quarterly meeting, and embrace a long-term perspective rather than trying to outguess the markets, will do better than people who are on a day-to-day doing something. Of course, I'm not talking of well-qualified smart traders. I'm saying people who try to guess the market versus people who try to understand the market are different animals. Thank you.